or our organisation. Or you might be further down the line where you're close to completion. However, whatever your stage, you'll have heard and be understanding more about employee ownership and what it can be. So we recently did some research and we identified the evidence of the impacts of what employee ownership can do for an organisation. And these are just some of them, which you can see on the screen right now. You'll see in the top left, employee owners are 8 to 12% more productive. 54% of employee-owned businesses have a net zero carbon management strategy. They invest more in their employees. The retention rates are greater. They're more likely to be recruiting in order for growth. Really fantastic, positive evidence about the impacts that employee ownership can have. So we as an organisation are absolutely delighted that you've joined this webinar to understand more and explore if it could be for your organisation. How we do that, the EOA has created what is known as the EO framework. For a business that's thinking about employee ownership and ones that are employee owned, we have a framework that considers the key approach, roles, and actions that are required in order for you to get fantastic results. Just to explain that a little bit more. As you see at the top, approach. Under approach, you need to have the right culture in place or be looking to develop the right culture that's going to embrace employee ownership and move from employees acting and behaving as employees, behaving and acting and feeling like they're owners of an organisation. Recognising the advantage of what employee ownership can bring and also the engagement tools that you have at your disposal. The roles are integral. How your governance structure is set up, which Jerry will explain a little bit more about very, very soon, is really crucial as to bringing employee ownership to life. The behaviours of the leaders, stepping back, allowing others to step up, and the employee owners themselves, because employee owners have a responsibility. They are now employee owners, not just employees. So what does that mean? What does it mean? But also what employee ownership is, but equally what it isn't. There's that understanding that's required. And within the actions, where does employee ownership fit within your strategy? How can you be more resilient as an organisation? And how do you then innovate being employee owned? You get all these elements right from this framework and it's evergreen, you can potentially have the right results for your economic results for the business, productivity grows, for the local economy, all of your stakeholders, and the environment as well, as we look towards a better form of business in this economy. So what do we do as an organisation? The EOA, just to do a little pitch, we host events like this. So we host webinars, we host in-person events as well. We have an online platform that you can access. We create content. We co-create that with a number of our members. So on this next slide that you'll see, it evidences all the opportunity that you have as a member. Some of you are members, but some of you equally aren't. Make sure you're making the most of what's available to you through the EOA. And one of those examples is our EO Learn training program. This is a portfolio of courses looking at key requirements based on that framework that are necessary for a business to be a great employee-owned organisation. So on this next slide, you can see examples of 3 courses that we've got coming up. So one, I talked about roles and the importance in governance, how to be an effective employee trustee, our most popular course by far. We're going to run a number of these throughout the year. If you're interested in the role, if you're looking to identify the right person, or they might already be identified and need the skills in order to develop and be effective, perfect course for you. The middle one, if you're getting to that point of becoming employee owned, how to create an engaged EO business. Surely that's what you want to achieve in the longer term. That's a short online course that's perfect for you. And what is really relevant, if you're definitely on that journey, and you should be and have to be thinking about, how do we tell everyone? Because that key message, that moment, that time that you have telling the team what employee ownership is and what it could mean is so intrinsic as to the first year, the second year, and beyond that as well. So really worth considering, and links will be dropped into the chat for you to connect to our webpage and understand more. So without further ado, our guest speakers. As I briefly mentioned, we've got Jerry Young and Tom Ledby from RVE Corporate Finance. They are specialists in employee ownership. They've helped transition over 30 organisations to become employee owned. And they supported Jay and the team at Milestone Creative to do exactly that. And also we've got Jay, who's founder and managing director of Milestone. As I say, Jay will talk to you about the thinking, the planning, what they went through in an organisation, and also what the impact has been. So they will present. You will have the opportunity to ask plenty of questions after they've finished presenting, and then through Zoom, we'll break out into rooms. These will be hosted, and Jay will be joined by a couple of colleagues as well, so they can tell you their experiences as being employees in an employee-owned business. So, Tom, if you'd like to join me on the virtual stage, I'm going to hand over to you, and you can talk us through those introductory pieces around RVE.
Thank you very much, Ollie, and good morning to everyone. Thanks for taking the time to attend this morning's webinar. As Ollie mentioned, RVE we're based in Marlow. We're a small team of lawyers and accountants that focus entirely on EOT sales. We've advised over 35 businesses into an EOT structure, varying in size from some very small businesses worth perhaps just over £1 million through to the very largest EOT on record that we're aware of anyway, a business worth £275 million. So that's a feather in our cap. We've advised businesses from a very broad range of sectors, professional services being probably the largest part of that, and Jay and her colleagues definitely fall into that camp as marketing and branding experts. But it works for other businesses as well. We've advised manufacturing businesses and construction firms and all kinds of sectors. Let's move to the next slide, please. Part of we are, as you might understand, evangelical about employee ownership at RVE, and we sponsored a great piece of research that was done last year by a think tank called Ownership at Work. They worked in conjunction with the Federation of Small Business to look at how employee ownership could fit into succession, particularly for that baby boomer generation that's currently beginning to retire and will continue to retire over the next few years. I'd really encourage you, if you're thinking about employee ownership, to take a look at this report. It's on the Ownership at Work website. The link's there at the bottom of the page. Look for publications that came out last November. The first part of it really describes the scale of the challenge. Lots of owners leave it too late. And it's a great waste in the economy of companies that simply go through perhaps a members' voluntary liquidation or some sort of other process. But successful organisations that for whatever reason fail to sell or fail to run a successful succession plan and cease trading. That's a loss for local communities, and it's a loss for UK PLC. So that's the first part of the report. The second part of the report identifies that employee ownership is a great option for lots of different types of businesses, and there's several case studies in the report, hopefully one of which would be relevant to your sort of organisation, which talks through in detail the owner's experience of moving into employee ownership. Let's move ahead to the next slide, please. The reason that we are so keen on employee ownership, and at RVE, we are corporate financiers, and we've worked on lots of other types of deals in the past in our professional careers. But EOTs are a very nice solution to succession. And here we've got a list of what we think are some of the real strengths of an EOT when you compare it with other types of exit. So we compare it here in the second column with a trade sale, so selling to perhaps one of your competitors, an MBO, a management buyout, that is with external finance, that might be sponsored through private equity or venture capital, or perhaps if your management team can raise the funds from friends and family, but using external finance. And then the last column is a management buyout, where you as the owner effectively lend that next tier of management the money to buy the company. And the flexibility that an EOT offers is difficult to explain, even in a webinar like this. Every case by case, every EOT is slightly different. Every company is slightly different. Shareholder circumstances are different. But what unifies them are the fact that these factors are all going to be important in the decision as to what happens to your company over the course of the next weeks, months, years. So firstly, you get to sell at fair market price. That's true in all cases. You can incentivize staff management. That next tier of management can be incentivized with equity. And we'll talk a little bit about how EMI schemes might work later on. You can continue working in the business. Perhaps you love your work, but you don't want to do it 5 days a week. Well, actually, you can, under EOT ownership, perhaps you can just think about scaling back your hours and let that next tier of management step up into leadership and take on a little bit more of the workload. Like I said, lots of flexibility in how you structure the deal and how the numbers work, how the governance works. The purchaser doesn't need to raise debt or equity finance. It can be used in certain circumstances, but generally, third-party finance is not used. That makes the whole process much more straightforward. You're not having to go through endless due diligence with either banks or third-party lenders. The big one here is culture. And actually, this table really describes the benefits of EOT to owners, but culture, and more important, independence, is something that your team will highly value. It effectively gives them job security for for as long as the business is viable. Lots of, even if it's not appreciated straight away, but it's clear when people are getting older and thinking about retirement, and that does unnerve employees within a company, thinking, what's going to happen to me? What's going to happen to my role? So and so can't carry on working forever. There's going to have to be some sort of change in the near future. So a move to employee ownership really does help address that and help employees feel much more settled in their organisations. As I said, not raising debt means that deal execution risks are low. You're not having to negotiate with third parties, with banks. You have control of the process. You pay no capital gains tax on the sale of the proceeds. That rate is normally 20%, and business asset disposal relief can reduce it to 10%. We'll see what the budget tells us, or we'll see what's announced in next month's budget. But we're envisaging that the special treatment EOTs receive is maintained. Lastly, you have control, and perhaps the word control is a bit strong, but significant influence over the business and its performance over the course of the earn-out process, if that's what you call the repayments of the loans. And then lastly, EOTs have this very special tax arrangement where individual employees can receive income tax-free bonuses in addition to their normal remuneration. So there's lots of things that are going to encourage employees and shareholders into thinking that an EOT works really well. We are now going to hand over to Jay. I'll let her introduce herself. And then once Jay has spoken, we'll hand then over to my colleague Jerry, who will go through some of the more technical aspects of an EOT sale.
Hi everyone, my name's Jay. I'm the Managing Director and founder of Milestone Creative, and I can tell you a bit about our journey becoming an EOT. So we became an EOT about a year ago, so we're fairly new at it, but I can tell you what experience we've had so far. So just let me share my screen with you. And Okay. Hopefully everyone can see that. So yeah, so Milestone Creative, we are a design and marketing agency out in Buckinghamshire. Oh gosh, right, hang on a minute. Your photographs are over my notes, so there we are. Milestone Creative was founded in 1995 by Ian and myself, and our creative director Peter joined us and became a shareholder in 2000. So the company was built on the principle that we could deliver amazing design and marketing solutions to our clients with integrity, respect and collaboration at the heart of it, while running a successful business. This was always very important to us. We're passionate about delivering the very best results for our clients and have always recognised that we do this as a team. So clients, employees, suppliers are all equally important in this relationship. Profit is important, but not at the expense of the quality of our work or the employees that deliver it. Over half our team have been with us 10 years or more, so I think that speaks for itself, but it's a good place to work. Right. Sorry, this is not clicking. Right, so this is our amazing team. This photograph was taken about 3 or 4 weeks ago, so it's very new. And we're outside our beautiful barn in Buckinghamshire. So as the three of us hit our mid-50s, we started to seriously think about our succession and retirement plans. We thought about a management buyout, but this was not really a viable option. We thought about a trade sale and started exploring how that might work. We talked to people we knew that had gone down that path, but we didn't really like what we heard, what we found out. Firstly, it could take a year to find, it could take years, a year, 2 years, 3 years, I don't know, years to find a buyer that was a good fit. And that was always going to be important to us. Then we heard about buyers reneging on their promises to honour the values of the business, uprooting the business to another location without warning, letting go some or all of the employees, or taking the client list for their existing business and closing it down completely. Then there were tales of onerous earnouts with unrealistic growth targets. And basically all of this didn't sound like the Milestone way of doing things at all. It was frankly depressing. So, you know, Milestone is our baby. You know, we've been running it for over 25 years, and everyone is like families. You know, we're a big team of people that work well together. So that was very important. So anyway, I'm going to stop sharing for a bit so you can see my face again. So yes, so in July 2022, I think, I received an email from RVE, from Tom actually, telling me about EOTs and how this might be a way to sell your business. The more I investigated it, the more I realised that this could be the way forward for us. It ticks all the boxes. We had a senior leadership team in place, primed for succession. Our legacy would be secure. Employees would have job security. They'd have a say in the future of the business and benefit financially from their years of loyalty. We could realise market value, have time to plan and implement a seamless transition to the succession team. And of course, 0% capital gains tax on the sale proceeds was very welcome. I presented the idea to Ian and Peter, and they liked the sound of it, and it was agreed that I would talk to RVE and explore this further. So after an initial meeting in February 23 with Jerry and Tom, and also with our accountant, I was convinced that this was right for us. We presented our findings, PLQ, who's our accountant, and we presented our findings at the AGM, which happened to be a few weeks later, and a further presentation by RVE to Ian and Peter was arranged off the back of that. RVE introduced us to some of the business founders they had previously advised, and we also found out another agency we knew had transitioned to an EOT. So we were able to get some insights about the process from people who had been through it. Once we were sure this was the way forward for us, we shared the idea with our senior leadership team, Howard and Jen. We explained how we thought it would work and made sure they were on board before progressing. As we had already been working towards them taking over our roles for a couple of years, this was a relatively straightforward process. We formally engaged RVE at the beginning of April, and they expertly guided us through the whole process. They took the time to understand our operations, gathered all the relevant information, and produced a valuation showing us their workings in meticulous detail. They were on hand to answer all our numerous questions, and there were a few, and patiently explained the more complex details as many times as required. They explained that an EOT had to own over 50% of the business, and that we could choose any percentage from 51 to 100% to transition. So we opted for 100%. This worked best for us, as we were all in agreement that we planned to retire at the end of the process, and we could maximise the capital gains tax advantages. So once the framework was agreed, RVE prepared and sent the TIS letter to HMRC, and within 3 days we had approval to go ahead, which is pretty amazing. It's very unusual. HMRC typically take 4 to 6 weeks, but I think the letter was so well written, obviously, it went through very quickly. At this point, we confidentially told a few other key team members, such as long-serving individuals and those that could assist with the smooth running of the process. Appointing the trustees for the EOT was the next step. So it was decided that I would be the trustee representing the sellers, as I have the most experience of the three of us with financial and legal issues. Jen was appointed employee trustee, as she had been handling HR for a while, and it was clear she would represent the employees well with her balanced approach to both team and business needs. And Tom from RVE was appointed independent trustee for the first year, as he was clearly accepted by all parties to be independent and could bring his experience and knowledge to help guide us through the process and through our new responsibilities. We have had 2 trustee meetings so far and found the process relatively straightforward. Personally, I can find it a little bit challenging, as I need to wear many hats. Obviously, I've always been responsible for the financial matters at Milestone, so I can find it hard sometimes to represent the needs of the sellers and the business and the trust when they are not fully aligned. But so far, it's been okay. It's not been too bad, but you know, it's something to be considered, I suppose. RVE's legal team then produced the necessary documents, which were numerous, and spent time with Jen and I going through them, making our amendments until we were completely happy with those. So I'm now going to get back to the slides, if I can work out how to do this. Just bear with me a minute. Right. So back to here. Right, so we decided that we would announce our EOT status to the remaining employees on completion day. We had been giving regular company updates to the team since lockdown, so it was relatively easy to have an update scheduled in the calendar and not make people wonder completely that this was a bit out of the blue. So about a week in advance, I sent out a message to the team saying that I had a special and exciting announcement to make, and they were all required to attend. I wanted to make it sound important without scaring them, you know, because people can get a bit nervous, especially since lockdown. So on the day, Tom, our independent trustee and advisor throughout, as I've mentioned, together with the RVE's legal team, arrived with all the documents, and we spent the morning completing all the regulatory meetings, signing all the documents in our boardroom. We had a celebration cake and champagne ready to go, and then we invited the team into the boardroom, and we made our presentation to them, and then followed that with a Q&A session. So I thought I could share the presentation that we made to the employees. I'm not going to dwell on the slides too much, but I can give you a quick overview. Thought it might be interesting. So here we go. So this was the first screen. So the future's bright, the future's orange. If anyone remembers the orange ads from the 90s, 2000s, that was, we sort of stole it. So this is, so basically, so we explained about what EOTs were, about the concepts. We showed them a few companies that were EOTs that they would probably recognize. Then we introduced Tom and explained who he was, and then we explained why we decided this route. So we went through these slides just saying about remaining independent, protecting the culture, staying in control, you know, that it would give them greater involvement for all, and an orderly succession plan that could be done over a number of years. And then employees acquire ownership and are eligible for profit shares with no financial outlay, which is always a nice thing to say. And then we explain how it works, we explain the structure. So, and obviously assuring them in the way that nothing much would change in terms of the day-to-day running, explained about the trustees and their role. And then, you know, we just said, we want Milestone to continue to be a great place to work, which is the ultimate aim. And so welcome to the future. Now be a bigger part of it was important. Then we thought, well, they're going to ask questions. So we had a question and answer session. We prepared a few questions we thought that they might ask and sort of had answers ready. So we ran through those. So, you know, what's in it for me? You know, all these sort of things that we thought we'd, you know, answer before they had the chance to ask. The valuation and all the rest of it, profit share work, how that works. And then, you know, about progress reports on the thing. That's something we've sort of added to our strategy. We do a strategy sort of meeting at the beginning of the year about how we're going to approach the year and what our goals are. And so we're making that now part of that to say where we're at from a percentage point of view, how close we are to the end game. So yeah, so just running through these, you know, we prepared a little sort of spiel about how we tell our clients. That was very important because, you know, even though we know it's a great story, they can sort of think, oh, what does that mean? Are these people going to disappear? And so we wanted to make sure we explained that it meant that things would stay pretty much as they are, and they would be more assured that people were likely to stay in the business for longer, and therefore they wouldn't have changes too much in the people that they deal with. Talked about how we were going to, you know, release it to press, and we thought we'd wait till we told the clients first, because we thought they're the most important people outside of our own employees. So, and there we are. So we ended with that, the award-winning strategic creative agency owned by its employees, which we think is a lovely story. So there were more questions that were asked afterwards, obviously, but overall the team were happy and fully on board with the new structure. I can't imagine how we would have done it without the expert support and guidance from RVE. They were really brilliant, and I thoroughly recommend them. So we completed our transition in early September last year. So we've just completed our first year as an employee-owned business. And so far, we have seen a positive change in attitudes in the team, which has been great. Here is our lovely team. We put this gallery up in our office to sort of just reinforce the fact that, you know, we are employee owned, so all our clients can see that when they come in. And so since becoming an EOT, the account directors are now actively engaged with the process of setting targets and forecasts for our clients. The wider team are thinking more commercially and trying to ensure their jobs are more profitable through greater efficiencies, but without compromising the quality. Our senior leadership team, Jen and Howard, have been working hard on raising their profiles on LinkedIn, have been attending in-person events and building a strong network of contacts. Jen has even had an article published in Marketing Week. They are already increasing their prominence in the business to replace us as leaders, which has been fantastic. They've also been having weekly business development meetings with the account directors to work on developing existing clients and growing the sales pipeline. They've also identified a couple of other team members, one account director and one senior creative, to support them, and have organised monthly EOT futures meetings with them to discuss future planning and employee priorities. So that's basically our story. So I thought I'd just give you a few pointers as to some advice about things that I think we felt were important in considerations becoming an EOT. So I'll just run through them quickly. So firstly, appoint an advisor, really important. I would strongly recommend doing that as early as possible in your process. Secondly, obviously, is your business financial structure strong enough? Ensure your EBITDA is sustainable, high enough to cover the repayments within an acceptable time frame, whatever that is for you. Be prepared to stay working in the business during the repayment process. I think it's important to be part of it still, even if it's you cut down your hours, just so that you can help steer it in the right direction. Make sure you get your money back soon. Be realistic about your growth, your business growth targets and the repayment schedule, and also be prepared that it might take longer than you think. Market forces change, all sorts of things can happen. So don't be too disappointed if it doesn't quite go as fast as you hoped. Then we feel it's really important to have a clear idea who will succeed you as leaders of the business. So really good to get that in mind before you take the leap. And then bring them into the conversation early. So any other key members of your team as well, make sure that they are on board with the idea and to include them in the planning, because it just will be so much smoother. Then don't spook your employees. This is really, if you're approaching retirement age, they will be already thinking, as Tom said, that what are your plans for the future of the business? You can't possibly be staying in it forever. So we just thought we needed to be careful about how we set up our meetings and planning sessions with RVE, so as not to spook them and start the rumour mill, because they could have just thought, oh, we're just going for a trade sale, and that could have made them nervous. So we had our meetings off-site for this reason up until the day of the announcement. Then when should you tell your employees? Well, obviously that is a very individual process. So you need to decide when you think would be best to announce your transition to an EOT to your employees. You know your employees better than anyone else. You might want to include them from day one. I've spoken to people who have done that. You might want to wait until you've received HMRC approval, so you know you can do it. Or you might think it's best to wait until the transition is complete. And on the whole, that's what we decided to do. So be ready for their questions. So be prepared to explain the ins and outs of EOTs in detail to your team. Try and preempt any questions they may ask and have answers prepared, as I showed you. RVE were a great help with preparing and delivering our announcement and presentation, because obviously they've got lots of experience, they've done it a few times. So be prepared to share more with your team. So you've got to be prepared to be more open about the running of your business with your employees. After all, that it's their business too. We regularly share our financial and forecasting figures with the team and involve them in setting targets. It really helps them think more commercially and reinforces their ownership of the business and its future. Every 6 months, we give them an update on the repayments as a percentage so they can see how progress is being made. So how will you tell your customers? An EOT can be a very, very positive story for you and your customers, but you have to be careful not to don't make it about exit strategies, retirement and tax breaks. They don't want to hear that. They want to hear that it's the positives for them, focus on the stability, the longevity, consistency that you'll be able to give them. Your customers may not understand what an EOT is and could see it as a negative if you're not careful. It's just sometimes people have heard about things and get them a bit muddled up. So, finally, be ready to let go. Sorry, I need to just scroll. So be prepared to start letting go and handing over more responsibility to your successors, your senior leadership team, and the wider team as well soon after transitioning. So because they need to be fully up to speed before your exit from the business. And, as business owners, we know you've been doing it your way for years and years and years, and it can be difficult to let go, but you have to start thinking in those ways, and also start planning what you're going to do when you have retired. Start getting those hobbies up to scratch. Decide whether you want to go sailing around the world or whatever it is. Just have fun preparing for the life after running your business. So that's me, really. So thank you for listening.
Excellent. Thank you very much, Joe. You've been very generous with your praise, and I do thoroughly enjoy being the independent trustee to Milestone. It's a terrific business. The 3-day clearance from HMRC was certainly a record for us.
Yeah.
We're not going to see those sorts of response rates anytime soon. Thank you for that summary. Jay and 2 of her colleagues will be hosting networking meeting rooms after this next section of the presentation. So Jerry, my colleague and founder of RVE, is going to be just talk through a few more slides. Can we get the slides back up on screen, please? I think we're going to start off with the basic structure of an EOT transaction. There we go.
Okay, well, thank you very much, Jay. It was a pleasure to work with you on that deal, and very glad to hear it's going well 1 year into your new EOT structure. So I think we've got a hard stop at 11:45, so I've got 5 minutes to go through 3 or 4 slides here. The way an EOT works essentially is it's an indirect form of employee ownership. So you can see on that diagram, the EOT buys the shares in the trading company from the vendor shareholders, normally the founders of the business, as it was for Jay's company in the yellow box. And the EOT becomes the owner, normally of 100% of the shares. It can be a lower percentage. And the EOT is run by trustees, typically a mix of maybe one of the founders, an independent professional, and one of the employees. I mean, it can be different mixtures, but typically the trust likes to have trustees that represent all those different stakeholders and has some professional advice as well from an independent professional. So the employees own shares through the trust, and if you're an employee, you participate in the trust for so long as you're an employee. But when you leave the company, you no longer have any shares. You don't take the share certificates with you and sell them. The trust keeps those shares, and the next employee is then eligible for profit share from the company as a form of dividend, if you like. As Jay was saying, when you sell your shares as a vendor shareholder to the trust, to the EOT, you don't get paid in cash up front. You get paid in deferred consideration or loan notes, as we call them. And typically, the trust is going to take 5 to 8 years to pay off the vendor shareholders out of the trading profits of the trading company. So it's sort of like an earn-out structure for the vendor shareholders over a 5 to 8 year period. Okay, we'll move on to the next slide. So EOT relief. I mean, obviously CGT is in the spotlight at the moment. EOT relief is a relief that was introduced back in 2014 to give sellers of companies, vendors, a relief from capital gains tax down to a 0% rate if they sell their shares to an EOT. The budget's happening on the 30th of October. We don't know if EOT relief will be impacted, but we hope it will remain. To qualify for EOT relief, it's a bit like the old entrepreneurs relief, or BADR as it's now called. You need to be selling shares in a trading company, not an investment company. So if you have a company which invests in property, that would be an investment company. A trading company is anything that sort of trades and has employees. You need to have a sufficient number of employees who don't already own a large number of shares in the company, which is called the 40% rule. The trust has to be properly structured to benefit all the employees, not just a certain section of employees. And the EOT must acquire control, at least of 51%, but also be able to effectively control the company. And also, you do need to be a UK tax resident to claim EOT relief. If you're an overseas shareholder, you will be taxed in your overseas jurisdiction on whatever gain you make. So EOT relief is obviously a big incentive for owners of businesses to sell their companies to an EOT, although it's not the only reason why you would want to be selling to an EOT. As Jay pointed out, there are lots of other benefits of pursuing this route. Okay, next slide. So the transaction has a number of milestones. The process typically takes about 3 to 4 months, which is a lot quicker than a trade sale process would normally take. Typically, the first phase is we assess the feasibility of doing an EOT. It may be the company doesn't meet those criteria that we talked about on the last slide, or it may be actually that the founder's expectations of value are too high, so the transaction won't be feasible. We then look at structuring the deal. Do the founders want to sell 100% or a lower percentage? We value the business. That's an important element of an EOT transaction. The buyer, the EOT, must be buying at a fair value, and the sellers must be selling at not more than market value, or else there's a risk of some nasty tax liabilities in the transaction. Once the deal structure and evaluation have been agreed with the business owners, we apply for tax clearance. So this is asking HMRC to confirm that this transaction would not be taxed to income in the hands of the selling shareholders and is being done for a bona fide commercial purpose. So it's called a TIS clearance, transaction securities clearance. Once we've got tax clearance, which can take anything from 3 days, as we heard from Jay, to a more normal 25 to 30 days, then the legal documentation will be drafted. There's a share purchase agreement. The trustee company needs to be set up. There's a trust deed that needs to be drafted. So various legal documents that are needed to execute the transaction. The trustee board, trustee company board needs to be constituted. And as I was saying, that's normally a mix of an independent trustee, an employee trustee, and a founder trustee. We can be the independent trustee. Tom is the independent trustee on Milestone, or we can help the company find another independent trustee and help them oversee the process post completion. Okay, next slide. So this is just a basic diagram which really talks through those different phases of an EOT transaction. So I won't talk to this slide very much, but you can see the various different phases. taking over overall about a 4-month period. Go to the next slide. So the role of trustees. So the important point, I think, to understand here, the role of trustees is a bit like a board of school governors. They're not running the school, like the headmaster or headmistress runs the school. But the school governors are there to make sure the ethos of the school survives and the school is being run by a competent head. So the trustees are not running the business, and therefore they don't meet every month. They meet maybe twice a year, and the board of directors reports to the trustees on how the business is doing and how the company is developing an employee ownership culture within the business and how well they're doing in terms of generating profits to pay off the loan notes that are due to the founder shareholders. But the board of the company very much remains in control of the strategy of the business, running the business, and the employees should not think that the trustees are now the new people who are the most important people in this business. They're not. They're overseeing the ownership of the business, but the business is still being run by the board of directors. Okay, we'll go on to the next slide.
Yes, this is just a little summary of some of the work that the EOA has been doing around their research into people-powered growth, and really to think a little bit about employees. So what is it that means companies become more effective? Research shows that employees generally enjoy higher engagement, motivation, and well-being when they work for a company that is employee-owned. And actually, that's, anecdotally, the costs of replacing people leaving your organisation and the cost of training those and getting them up to speed. You can understand why retaining your best employees can really help drive business performance. And employee ownership is a fantastic way of incentivising people to stay with your organisation. Clearly, employees will earn more. We generally encourage people to consider having an employee profit share from day one, but certainly in the long term, when those vendor loan notes have been fully repaid, employees will share in the profits of the company and take home more money, which is clearly a great way to retain staff and recruit the very best. And then lastly, transparency. This is a big key part of successful employee ownership. Jay and her colleagues have always run a fairly transparent organisation. That's not always the case, and encouraging owners to realise that employee ownership does need a different way of communicating with staff and to improve that transparency, or improve transparency to communications is I think an important part of the process. There's some statistics that the research shows that on aggregate, EO businesses are more productive. They are more likely to invest in research and development because those employees, it's all of a sudden it's their money they're investing, and they can see where it's worth spending money on new projects. So that's a really interesting statistic. And employee-owned businesses tend to grow faster, as you can see that last bullet point on the right-hand side, showing that that over 50% more likely to be expanding their workforce. So you can see that employee ownership it's certainly not whatever you've got, magic silver bullet for success, but can provide a fantastic way for your business to thrive into the future as an independent business with the same ethos and expectations and customer service and all the good stuff that hopefully you've managed to put into your own organisations and take that forward into the future. Question and answers, I think we're on to now. If anyone needs to jump off early, we've got a website, rvecf.com, and there is my email and phone number. Please feel free to drop me a line if you've got any questions, or if you need to jump up, to leave this call now. Please feel free to get in touch.
Perfect. Thank you very much, Tom. So Tom, Jay and Jerry are going to join me on the screen now and facilitate some questions that are coming through. So thank you very much for those that have already put forward, and please do feel to keep them coming. The first one's around recruitment. So the question is, do you realistically expect the next successor to be within the business or have to recruit outside? I'll chip in a little bit first, Martin. Depends. Which isn't a very helpful answer, but it really depends on the skills and competencies of the next generation of potential leaders you might have in the organisation. Being employee owned, you would think that you would be looking to nurture that talent through. Yes, absolutely, because they've already been part of the organisation. They understand the legacy, the vision, the purpose. They know the team. Clearly, there's advantages. But at the end of the day, if that next successor is not there, then you do need to look externally. Interesting conversation at an event we hosted yesterday. Yes, it's recruiting to skill, but it's also recruiting to fit. Does this next person, whether it's the leader of the organisation or within any role, fit the business that is now employee owned? That's got to be crucial. Anything additional to add on the panel?
Yes, just to say that, as Jerry said, this is a 5 to 8 year loan note payback period that goes with most EOTs. That's a significant time period for you to think about who is going to be successfully leading the business into the future. If you've got people that are good in your team but not quite there, it's plenty of time to train them up. And we would always, I think it's good EO value to look internally for promotions, always look to make the most of your people, train and develop their abilities. That also, over the course of that time, there will inevitably be some churn. So I wouldn't. It's not a panic if you don't have that right person in the business at the moment. But it is something to bear in mind as you think about exiting either partially or fully from the business.
Well, Leslie, you've raised your hand. Feel free to ask a question.
Yeah, and in fact, I have put it on the chat. I've got 2 questions. I'm already partway down this route, so we've just gone for HMRC approval, and it was longer than 3 days ago, so we'll wait and see how long it takes. But I have 2 key questions. So I have a care business, so I have very definite 2 groups of people. One is the sort of office commercial, management staff, and one is my carers. Am I able to have 2 different pots of sort of shares?
No. In a word, Leslie, I'm sorry to say, no. So a nice way to think about this is employees under EOT and employee ownership. There is remuneration for 2 elements of your work. So firstly, there is your job. You get a basic salary, you get a performance bonus, you get overtime, you get sales commission, all that good stuff around being an employee gets wrapped up in salary and bonuses. Yeah? There is then a second amount that's paid by the trust in recognition of your ownership rights.
So you could, in effect, Tom, say, right, once the owner's been paid out, the company retains 30% of the profit. For future developments or whatever, 30% of the profit goes out as dividends equally to every employee, and 30% is retained for performance bonuses or whatever that might be. But the only tax efficient way is that dividends that go equally.
Yes, so the special income tax treatment is granted to qualifying employee profit share bonus payments.
But you can set what the qualifying components are.
Yeah, well, there are just 4 equitable criteria, as they're known. So, firstly, you can pay an equal share of that profit pool. The bonus, the total amount of money. You can split it equally amongst all your employees, and everyone gets the same. That's one way. You can do it pro rata to salary. So that's you see that with John Lewis, for instance. That's the normal mode that they will set 5%, 10% of salary, whatever the number is, depending on performance that year. You can do it based on length of service. So if you've got staff that have worked, if you've got lots of staff that have worked a long time and you want to treat them a little bit more generously. You can include that as part of the calculation. You can actually sort of tune this and choose varying elements with various weightings. And then finally, you can do it on hours worked. So that might be in your, if there are people that have really gone over and above what's been expected in the last trading period in your organisation, but in loads and loads of overtime, you could put some more weighting on their performance there.
Okay, and then one more question, if it's allowed, and this is probably as much to Jay as anyone. How on earth, 5 to 8 years, if you're told it's going to be 5 to 8 years before you really have total control of this company, how do you keep people motivated?
Well, yeah, I can see, yes, it does feel like that, but they are involved now, and we keep them motivated. But the idea is that, yes, the business has to be successful for us to get paid that money back. So it's in their interests as well as our interests that the business is successful now, so that it gets paid off as quickly as possible, so that that day comes forward quicker. I think that's sort of
it's not a time, Leslie. It is an amount of money.
Yeah,
and that's the harder people work, the quicker that pile of debt will be reduced to nothing.
And presumably they have to have transparency as to what has been paid for the company.
I mean, they don't have full transparency of all the numbers, but they know the rough framework. They also, I would say, they know what the business is earning and they know what the profits are. So from the business transparency, they have transparency on that. We've been in the habit of reporting more of that since lockdown. I think as part of our reassurance that we were trading and that we were going to be okay getting through the whole horror. But so that sort of culture was already slightly embedded, which has helped a lot.
Okay.
Yeah.
And presumably you can say, do you know what, I'm going to take, rather than 5 years, I'm going to take 7 years and keep a pot of money that we can still distribute so that people feel engaged.
Yeah, we have set aside a ring-fence proportion of the profits anyway, that they get that in the meantime.
Okay.
So there is some bonus coming to them that's tax-free up to 3,600. None of them are at that level at this point anyway, but we know that up to 3,600 they will get tax-free. So we've added that, they get that bit. I mean, it's not a lot at the moment, but it will get bigger as the company does better, because the bigger profit means the percentage is a bigger amount.
Okay.
So just to clarify, it's free of income tax, but it does suffer employers and employee national insurance contributions, and it does also count for student loan.
Yes, that's true. Yeah.
Okay. Thank you.
Thank you all. Other questions coming in, but also Leslie, just for right to your point, we're talking about a lot of this conversation is around employee ownership trusts. In order to incentivise and reward perhaps senior figures, you might want to consider share options as well, that you can balance between the two and take a hybrid approach to employee ownership.
Yeah, everything I've spoken to quite a few companies, and everything I've learned is keep it simple. Seems to be as soon as you start complicating it, it makes it.
We can have a conversation outside, but share options, they're not complicated additionally.
Okay.
Thank you. What I would say in terms of the language that's used as well, I think a really key point, the use of the word control. Leadership behaviours will dictate a considerable way as to whether that transition to employee ownership and the feeling of, is this business employee owned or not, will have such an impact based on those leadership behaviours. That has to be a fundamental planning for and change. A business doesn't have to be 100% employee owned to feel like it's an employee owned business. I can use Lush, an example, who've got 10% of their shares in an employee benefit trust. You speak to most people that work for Lush, they will recognise that they're an employee owned business. So the language that's used, it's more so the behaviours of the individuals and those roles that are key to making this work. I'm going to come to a couple of questions that are posted in. Thank you very much to Kathy. It's a long question, but I'm going to go word for word so I don't get it wrong. And we've gone down the valuation stage, and due to the nature of our business, we may be looking at a prolonged buyout period, possibly up to 12 years. We've been advised that interest is not usually applied for possibly 5 years. Is that normal? My worry is that the current employees, who we want to reward, have to wait a long time to really benefit. Is external finance a better option to set repayments, and are there any finance sources that understand EOTs?
Well, shall I take that one?
Go for it, Jerry.
Yeah, so, I mean, we've done over 35 EOT deals now, and I've been the valuer on each of those deals. And a 12-year payback period is unusually high. I mean, most companies, small companies, will be selling on a multiple of about 6 times EBITDA, operating profits. And with a bit of growth in the company, that should be able to be paid off over 8 years. You're paying off that amount out of after-tax profits. So, a 6 times EBITDA would normally translate to maybe an 8-year pay down period, depending on how quickly the profits in the company are growing. 12 years is very long, a very long period. There may be a reason why it's taking that long. The business may need to reinvest a lot of profits. It may be a very capex intensive business. So that's not saying that the valuation necessarily is too high, but if we see a 12-year payback period, it's normally a bit of a check on the valuation. The valuation looks a bit high. We never recommend interest on the deferred consideration, the loan notes. It's tax inefficient, and it creates another burden for the company to have to finance if it gets in arrears of the initial payback amounts. We have a long stop date where there's an event of default. So if it was an 8-year payback period, if it hadn't been paid back maybe by 12 years, a 4-year grace period, then that's an event of default. So it buys the EOT some time, and it doesn't place pressure on the trading company by having interest on a large amount of debt. So I think, the issue is 12 years is a long time for people who are selling their shares, have to wait, maybe funding their retirement. And it's a long time for the employees to have to wait to really see any benefits from the equity vesting with them in the terms of profit share bonuses. So, I don't understand the nature of that deal, but that's our experience on that question.
We've come across this before, Kathy, where businesses are in highly sought after categories. Dentists, IFAs. There was a time a while ago when perfume makers were in incredible demand for some reason, and and market level pricing drives very high multiples, perhaps 10 times earnings is fair market value.
We're looking at 7 times a multiple.
Is it? Okay, so that shouldn't. I mean, with a bit of growth, Kathy, if is the business doing well?
I don't think it looks like that, but the people we're dealing with are so glum about everything.
And do you mind me asking what does the business do?
We're vets.
Ah, okay.
That's a very reasonable multiple for a vet's business. Yeah.
Because I mean, they were up to 12 at one point, which is ridiculous. Yeah.
So you shouldn't have huge amounts of capex. Presumably, you're not looking to grow by acquisition. You're not needing to spend lots more money on expensive veterinary equipment. You've got that already. I guess.
We tend to go and buy toys, but yes,
yeah. So I'd ask them to take another look at the numbers. Bake in 5, 6, 7% growth year by year, and
they don't seem to be prepared to do that. They seem to they're just being so glum about it all that it's sort of.
Yeah, I mean, that's unusual because, I mean, the valuation is basically looking backwards that establishes 7 times sustainable EBITDA is basically looking backwards, maybe your current year as well. So in terms of the forecasts, that's not a sensitive issue for your financial advisor. It's something that management should be able to guide the advisor on. If you're a vet's business, you should be growing at least 5% a year.
We are.
Yeah,
more than
10% a year.
Yeah.
That should be put into the projections, and that should be put into the pay down profile of the loan notes, which would significantly reduce from 12 years to about 8 or 9 years.
They don't seem to be prepared to do that, and they seem to want to hold an awful lot of capital within the business, which means that it just looks a very long time.
Well, I mean, that's not
we can pick it up offline, Kathy.
Yeah.
Another consideration might be
so the other issue, did another meeting with the EOT, and it was actually somebody who'd got 100% external finance. Is that something that is worth looking at?
Well, I mean, external finance is, if you own your vet's practices, you've got a lot of property in the business, then potentially you can borrow against the property value within the business. The problem is with an EOT structure is that if you borrow in the trading company and then you use that money to pay out to the vendors, you probably go into negative distributable reserves. It's a bit of an accounting issue, this.
Yeah.
So the borrowing needs to be done at the EOT level,
right?
Not at the trading company level.
Okay.
Because the EOT is not it's not the holding company of a trading group. So this is a bit accounting, tax, technical stuff here. You can't get tax relief on the interest payments on the debt. So let's say you're paying 4% over base, or let's say 8%. You can't offset that against the profits in the trading company. So effectively, it becomes like 10% interest.
Okay.
You don't get the corporation tax relief. So it's very, very expensive debt. And you'll only have, on a 7 times multiple, even with property backing, you'd only be able to get maximum a third of the deal value paid out upfront, financed by debt. Okay. So the other 2/3 is then being subordinated to the debt because you'll have an amortization profile. So we find debt can work, but often when you look into the detail, where it works best is you have, let's say, 4 shareholders, one of them's got 15%, and you want to buy them out by borrowing a bit. They get cash, they retire, all done, fine, nice solution. But you can only really use it to finance small amounts of payouts, not 40-50%.
Yep. Okay.
Thank you. Thank you, everybody, for your questions. What we're going to do now, we're going to open up some breakout rooms. So Tom, Jerry, Jay, and also we're going to be joined by Howard and Roseanne from Milestone Creative. They're going to host a room each. You can basically choose which room you're going to go into, and also there'll be colleagues from the EOA in the EOA related room as well. So you can ask them anything you like related to employee ownership, and we'll do our very best to answer that. So options all jump up onto the screen now for the rooms for you to choose. So to wrap us up, I mentioned a bit about the EOA. I'm going to re-emphasize the training courses that we've got available to us, especially, but not with those dates because they've been and gone. So we'll move on to the next slide. But we do have a how to become employee-owned session that's coming up in a couple of months' time. There's a link on the website there is where you can find out more about the courses that we offer. We do have an annual conference, which Nicholas was just asking about. So an annual conference, 2 days in Telford, 26th and 27th of November. My colleague will post a link in there right now. So that's 2 days immersing yourself and anybody else in your business that has an interest in employee ownership. There's a whole track of sessions all about becoming employee owned. There's a number of sessions about the first 1 or 2, 3 years, and then beyond that. It covers everything that you'd be interested in considering. Of course, I'm going to say this. I would strongly recommend at least exploring the program and then considering coming along to that event. So it is time for the thank yous, because I'm conscious of the time that we're on. So thank you to Jerry, to Tom, and to Jay for taking the time to put that presentation together. Thank you for the others hosting the tables, and thank you for firing your questions through to us. You know where we are if you've got anything else. And there's a QR code there. Everybody loves a QR code. A little bit of feedback always is appreciated. So thank you very much indeed. Enjoy the rest.
Thanks very much, Ollie.